Good day, everyone. So now let's move on to chapter 10, which is entitled Operations Management. So the learning objectives for this chapter is to first to define the five functions of management, and second, describe four types of policies that should be included in an operations manual. Let us now proceed to management functions. In management functions, there is this thing called planning, which involves analyzing information, setting goals, and making decisions about what needs to be done to move the business forward. Its activities should be performed in a timely manner because time is money. So, there are three types of planning, which are the following: strategic planning, which is setting broad, long range objectives to achieve the long term goals of your business. Second is the intermediate range planning, which is preparing detailed plans and strategies for achieving goals within a 1 year period. And excuse me, the last one is called short-term planning, which is planning for the day-to-day operations of the business to achieve the goals and objectives set in intermediate range planning. Then, in a management function, there's always should be a manager. So a manager is the person responsible for planning, organizing, staffing, implementing, and controlling the operations of the business. Those are the functions that all managers need to perform, no matter the size or type of the business they manage. Next is management. Is the process of achieving goals by establishing operating procedures that make effective use of people and resources. All functions of the management work together. Next, in management function, organizing is one of the important things to do. So, organizing is basically you identify and arrange the work and your human resource in order to achieve the goals that has been set for the business. So in organizing, um, these are the following that should be done. First, assignment of tasks. Second is the grouping of tasks into departments. Third is the organizational structure, and the last one, you should allocate the resources all across the organization. Next is you staff your employees in your organization or in your company. So in staffing, this includes the activities that your employees should be doing. Um, are like hiring employees, you obtain or hire employees, you train your employees, and you compensate, of course, your employees for the work they done to your business. Next is the implementing. So when implementing, you involve directions and you lead the people in your the people involved in your business to, of course, accomplish goals of the organization. um, it is accomplished through communicating the directions you make, the assignments you give, and the instructions you also give to your employees. Then next is the management style. This is how a manager behaves towards the work or towards the employees. So they use different styles based on the characteristics of the employees being managed. So in management style, there is two different types of style, which are the authoritative management and the democratic management. But first, let us discuss the authoritative management. So the authoritative management, this is the directing or the autocratic management style in which the manager is directive and controlling. So in this type of management style, managers highly involves themselves into the work, and the manager makes the major decisions and closely monitors the work of the employees to be sure that the work is done correctly. Next is the democratic management or the participatory management. This is the type of management style in which the manager involves employees in the decision making and the manager provides little to no directions. Next, actually, there are types of um, three types of management style. Because the last one is the mixed management, which is the combination of democratic and the authoritative management rather. So this is, as what I've said earlier, this is the combination of the both. I have mentioned earlier the both styles. So the last one is the controlling. This is the process of setting standards for the operation of a business and ensuring those standards are met.
Good day, everyone. I'll be discussing the importance of an operations manual in running a business efficiently. This manual serves as a guide that outlines all the essential rules, policies, and procedures needed for smooth operations. It can also be supported by a separate employee handbook to detail internal regulations specifically for staff. First, we have the operating policies. These policies define the daily hours of operation. It's essential to set business hours that are not only consistent but also convenient for our customers, ensuring accessibility and reliability. Next is customer service. Since customer satisfaction is key to business success, we need clear policies on handling product returns and follow up services. This ensures customers feel supported and valued even after the sale is made. Now let's talk about delivery policies. For, for businesses offering delivery, it's crucial to have clear guidelines, especially when products are bulky or when delivery enhances customer convenience. These policies should cover delivery times, charges, and procedures. Lastly, safety policies are critical. A safe environment benefits both employees and customers. Therefore, safety procedures must be part of employee training, and safety rules should be clearly communicated and enforced at all times. In summary, having a comprehensive operations manual helps maintain consistency, efficiency, and quality in all aspects of the business. It protects both the company and its people, making it an essential tool for.
So, what is inventory? Inventory is the stock of goods that a business sells. Managing inventory well is important because it helps a business avoid wasting money and losing sales. So, businesses have to balance the cost of keeping inventory, like storage, insurance, and taxes, with the benefits of always having products ready for customers. So, managers need to solve some problems when it comes to inventory, like keeping enough items in stock, especially fast moving ones, selling inventory quickly without running out of stock, buying in bulk to save money but not getting stuck with too much or old stock, and lastly, making sure items don't expire or go out of style before they are sold. So, what is a purchasing plan? A purchasing plan helps make sure the business has items when they are needed. This means planning ahead, ordering the right amount, and having items delivered on time. To know how much to buy, business use this formula. Beginning inventory plus purchases minus sales is equals to ending inventory. So let's use an example from the book. So Alan owns a car parts store. He starts with $40,000 in inventory and he expects to sell $80,000. He wants to end with $25,000 left in stock. So using the formula, $40,000 plus purchases minus $80,000 is equals to $25,000. But Alan finds out that he needs to buy $65,000 in new inventory. So, planning deliveries, Alan doesn't want all 65,000 worth of inventory delivered at once. Why? He doesn't have enough cash or space. He knows some months are busier than others, so he plans most purchases in spring when more people fix their cars for summer travel. And also, he avoids buying too much in January and February, which are slower months. So, in conclusion, In a short, inventory management helps businesses, or in short, inventory management help businesses avoid waste, save money, always have product ready for customers. Planning ahead with a purchasing plan makes the business run smoothly and profitability.
Hello everyone. Moving on to our next topic. We are now going to talk about how to track your inventory. So these are divided into two methods. So this is a crucial part of running any business that sells products. So let's break down to two common methods, the periodic inventory method and the perpetual inventory method. So first, we have the perpetual inventory method. So what is this? So for perpetual inventory method, this keeps track of inventory levels on a daily basis. So what do we mean by that? The perpetual inventory method is an approach that keeps track of inventory in real time using computers or stock cards. So what is a stock card? A stock card is a paper inventory record for a single item. So this updates your records every time something is sold or added. This method helps ensure you never run out of stock and can be very efficient for businesses with large inventories. So to make it easier, many businesses use point of sale or POS software. So what is this? What is the point of sale POS software system? So this updates inventory records as each sale happens. So barcode scanners and credit card authorization systems can be integrated into the POS system. Next, we have the periodic inventory method. So what is the periodic inventory method? So some businesses use the periodic inventory method, which involves taking a physical count of your merchandise at regular intervals, such as weekly or monthly. So what do we mean by that? This method involves physically counting your inventory at regular intervals, like weekly or monthly. It is especially used for small businesses. So you simply count how many units of each products are in stock, then compare it to your reorder points to decide what needs restocking. So for the short summary, in summary, the periodic inventory method involves manually counting stock at regular intervals and is ideal for small businesses. In contrast, the perpetual inventory method uses technology to track inventory in real time, so providing greater accuracy and efficiency. So regardless of the method used, it is important to conduct a physical inventory at least once or twice a year to catch any discrepancies. So many businesses also rely on point of sale software system to automatically update in inventory levels and generate useful reports for restocking decisions.
Everyone, my topic is manage your inventory. The decision of maintaining inventory depends on three key factors. First is cost of carrying inventory. Holding inventory comes with several costs, including first is obsolescence. Inventory can become outdated or no longer in demand, leading to potential losses. Second is deteriorations. Some items can spoil, break, or lose quality over time, resulting in losses. Third is interest. If a business borrow money to finance its inventory, it will incur interest expenses. Fourth is insurance. The cost of insuring inventory against theft, fire, and other disaster. Lastly is storage. The expenses associated with storing inventory, such a warehouse rent or additional space. So next is cost of being out of stock. Running out of inventory can also be costly, as it can lead to lost sales and customer dissatisfaction. If customers repeatedly find that business is out of the item they want, they may choose to shop elsewhere, leading to a loss of customers' loyalty. Then lastly is stock turnover rate. The stock turnover rate indicates how efficiently a business is managing inventory. Uh, a, a high turnover rate generally suggests that inventory is being sold quickly, while a low turnover rate might indicate slow moving or excess inventory. For example, a store that sells all all of its merchandise 4 times a year has a stock turnover rates of 4. That's all. Thank you.
Let us now proceed to key financial statements. These three financial statements are essential. The balance sheet gives a snapshot of your business financial position. The income statement shows how much your money your business earned or lost over time. Then lastly, the cash flow statement is especially useful because it tracks the actual cash movement, helping you see if you can meet short-term obligations. Sales and profit analysis. Tracking sales helps you plan better. Look at trends over time and see which products bring in the most profit. The net profit on sales ratio tells you how much actual profit you're making from your total sales. It is a key indicator of your business efficiency. To calculate net income, start with your gross profit. This is your income before subtracting expenses. Then take away your operating costs to get net income from operations. Finally, subtract taxes to find your net income after taxes. This number shows your actual earnings. Profit goals and break-even analysis. Set a profit goal each year to guide your decisions. Break-even analysis tells you the exact amount of sales you need to cover all expenses. Once you pass that point, every sale starts generating profit. It is a helpful tool for planning growth and managing risk.
Prepare and analyze financial statements. Take note that in order to manage a business properly and successfully, it is important to understand and analyze financial statements. Financial statements show how well your business is doing financially and help you track profits, monitor expenses, and set future profit goals. Prepare financial statements. Initially, you will prepare pro forma financial statements based on projections. Once your business is operating, you'll begin preparing actual financial statements that reflect real financial performance based on recorded data. There are three main components that define your business's financial position. Firstly, assets. What your business owns, like cash, equipment, and inventory. Secondly, liabilities. What your business owes, like loans or unpaid bills. And thirdly, owner's equity. What remains after subtracting liabilities from assets? It reflects your ownership value in the business. They are all recorded on the balance sheet. The income statement shows a company's revenues, expenses, and profit or loss over a specific period. Cash flow statement shows how cash moves in and out of a business. For example, the operating, investing, and financing activities. Analyze sales. Understanding your financial statements allows you to determine how much you need to sell to earn a profit. By examining your sales records, you can identify trends, forecast future sales, and make informed decisions. Analyze sales by product. Analyzing sales by product helps you decide which inventory to stock. This supports better inventory management and allows you to focus on products that generate higher profits. For example, you run a home appliances store. Your total sales for the month are 300,000 pesos. Air conditioner sales amounted to 165,000 pesos. To compute the percentage of air conditioner sales, i-divide mo ang 165,000 pesos by 300,000. So 165,000 divided by 300,000 is equal to 0.55 or 55%. Meaning, 55% ang sales ng air conditioner. Moving on to analyze net profit on sales. Your income statement reveals whether your business is making money and how much profit you're earning from total sales. This helps in setting realistic profit targets. To measure profitability, use the net profit on sales ratio. Net profit on sales ratio equal net income after taxes divided by net sales. So here are the steps to calculate net profit on sales. First, you have to calculate the net sales. Gross sales represent the total sales amount. Net sales are gross sales minus any returns or allowances. The second step is to calculate net income after taxes. This involves three calculations: gross profit, net income from operations, and net income before taxes. Also, note that gross profit is the profit before operating expenses are deducted. Net profit on sales is important because this calculation shows how profitable your business is. You can use this ratio to compare this year's profits to previous years. And if the ratio is too low, you may need to reduce costs, raise prices, or boost sales to improve profitability. Set and meet profit goals. These goals represent the amount of profit you hope to earn during a specific year. Setting a profit goal helps guide business decisions. For example, if you aim to earn 100,000 pesos in profit this year, your financial planning, including sales strategies, expense control, and pricing, should support this target. But obviously, if you're going to set goals, kailangan attainable. Lastly, break-even analysis. A break-even analysis helps you determine how much sales are needed just to cover all expenses. The break-even point is where total revenues equal total expenses. At this point, you're not making a profit, but you're also not losing money. Once you pass this point, all additional sales contribute to profit. For example, if your total monthly costs are 20,000 pesos and each product earns 200 pesos profit, you would need to sell 100 units to break even. Kasi 20,000 divided by 200 is 100. So, kailangan mong magbenta ng 100 units para lang mabalik yung cost mo.